Welcome to this IFRS Keys presentation by BhalaGood. I'm Glynis Carthy, and in episode 1 of the coronavirus series, I will be taking you through the initial IFRS thoughts. This presentation is based on a publication that was first issued in March 2020, which has since been updated in May 2020. It focuses on the key accounting issues that could be affected by coronavirus. There is no doubt that the effects of coronavirus are proving to be significant. Personal issues aside, businesses face some key risks. Can they actually survive? Can they pay their employees? When will they be able to trade again? All real business issues. In the midst of this, it is easy to forget the accounting. This episode highlights some of the areas where coronavirus could affect companies when they prepare their financial statements. It can also be used when discussing business issues at board and committee levels so that directors know what to expect in the financial statements. Although it looks at International Financial Reporting Standards, or IFRS, the same concepts are applicable to UK GAAP and to IFRS for SMEs, or International Financial Reporting Standards for small and medium entities. This slide and the next 3 slides are based on the publication. You will see in it that I've got all the accounting standards, and also in some blocks there's a possible impact listed. So what it's trying to do is to show some of the impacts that coronavirus could have on the accounting, but it's not all the impacts. As we go through this coronavirus series, we will be discussing some of these impacts in a little more detail, and therefore I'm not going to go through each aspect in the slides. So perhaps just to pick one on this slide, second from the bottom, financial instruments IFRS 9. An example of where we would have a significant impact or could have a significant impact relates to the impairment of financial assets. So for example, trade receivables, we might be looking at loans, we might be looking at lease receivables. We might also be looking at significant volatility when we are fair valuing certain financial instruments. For example, we've seen already that share prices have changed significantly. And also we could be looking at what happens when we renegotiate certain liabilities. Does it result in them being de-recognized and a new liability being recognized? So those are just some of the impacts that we could be looking at on this slide. I'm going to choose 3 standards just to highlight on this slide. The first is fair value measurement, IFRS 13. Then we will be looking at presentation of financial statements, IAS 1. And then lastly, events after the reporting period, IAS 10. So just to point out on IFRS 13, obviously many items are affected by this standard, whether it's agriculture, whether it's investment property, financial instruments, and we've already seen significant volatility in fair values, and there's going to be a lot of estimation uncertainty around fair values. When we look at presentation of financial statements, then is the company a going concern? What happens if there have been breaches of covenants? How does that affect classification of liabilities, for example? Also, judgments and estimates, quite significant issues to consider, quite significant disclosures going forward, and that will be what we discuss in episode 2. And then moving on to events after reporting periods, our post-balance sheet event standard, significant judgment around whether something is an adjusting or a non-adjusting event is going to be required, and obviously disclosure around that as well. On this slide, I'm going to discuss 2 issues, the first being employee benefits, or IAS 19, and thereafter government grants, or IAS 20. So starting off with employee benefits, obviously one of the key issues that could arise is whether employees will be terminated, and if they are, when we account for it and how much we account for. Then there's issues around sick leave and obviously holiday leave. Moving on to government grants and government assistance. Various types of government interventions are being made around the world. And one of the issues is going to be to try to determine whether it actually is something that qualifies for application in terms of IAS 20. So looking at government loans, possible government grants, possible government assistance. Is IAS 20 applicable, or is another accounting standard applicable? And obviously IAS 20 is not a standard that we all look at every day, but what you'll see is that it's going to be one that's quite significant to try to determine how we account for this government assistance. I'm also going to be looking at two issues on this slide. The first is impairment of assets, IAS 36, and the second is provisions, IAS 37. Starting off with impairment, clearly impairment is going to be significant, whether we're talking about impairment of non-financial assets or financial assets. Now, IAS 36 looks at the impairment of certain non-financial assets, and typically you would only be testing for impairment where there's an indicator of impairment. There are obviously certain exceptions to that. However, it's very likely that coronavirus is going to be an indicator of impairment. And also just to bear in mind that there are extensive disclosure requirements in IAS 36. If I look at IAS 37 provisions, one of the areas that could be quite significant is whether a contract suddenly becomes onerous. What do we measure around that? And obviously any certain disclosures around it. And then as companies might need to start restructuring, applying the restructuring requirements in IAS 37 as well. Thank you for listening to episode 1. If you have any questions or any feedback, please use the contact details on this slide.